Hi, everyone. Thanks for joining us today. We're talking to David Prentice of Brookside Energy. David, you've had a fantastic half-yearly result with revenue up 49 times to 22.1 million Aussie and net profits at 4.5 mil. A massive swing into the green from last year's numbers. How are you feeling?
Yeah, pretty excited. And nice to be speaking with you this afternoon, Timothy. So yeah, look, those some fantastic numbers. We had I guess record production of 250,000 barrels of oil equivalent for the half. Very strong realised pricing, sort of $65 per BOE or thereabouts, realised pricing on the sales side. OPEX, sitting around, around $8 per BOE, which is really a function of the very high quality product that we produce and the fact that we're, not moving very much water and we're very close to infrastructure. So, really good result. All of that translated into record EBITDA for the half of almost $9 million, which was obviously pretty impressive. And finishing out the half with in excess of $30 million cash at bank. So a very, very, very strong performance and obviously a very exciting time for the business.
Yeah, no, definitely 100%. I agree. There's some great numbers and a solid turnaround as forecasted by yourselves. But can you tell us, what's driving the revenue and the increased margins?
Yeah, look, I think, obviously commodity prices are helping. We have seen prices drift off a little bit in the last little while, but it's really the strong well performance really. So, we're really seeing very strong performance from our dual well and our ranges well. That production is really what underpins these numbers.
Yeah, great. In the last couple of years, Brookside's been very clear about its three-pillar strategy. Can you tell us how you've executed that in the last 6 months to capitalize on some of the trade wins that we've talked about, if any?
Yeah, no, absolutely. So look, I think that three-pillar approach, which is really kind of, I guess, seated in a business model that many of our unlisted private peers in the US have been using for many, many years, decades, successfully executing this strategy. And that's those three pillars being sort of the operated drilling, the land and leasing, and then the opportunistic sort of acquisitions pillars. They're important to the business. And we've really stayed true to that strategy all the way through since the inception of the business, and really making sure that all the decisions we make are really, I guess, focused on what's best for shareholders, what's going to deliver the best returns for shareholders. And so we've remained focused on those three pillars. And I suppose, some of our investors, from time to time, shareholders get frustrated that, perhaps, we don't appear to be pursuing one part of the strategy more aggressively than the other part. But I guess what I would say to people is that we can and do all three of those things all the time. And that's, super important, because we need to stay nimble. We need to be focused on what's going to deliver the best economic outcome for our shareholders, and focusing on those three pillars is the way to achieve that. Yeah.
And I think, the numbers really reflect the success of sort of the focus that you've had in the last 6 months.
Yeah, absolutely.
Yeah. You've achieved obviously a lot of financial milestones this half year release, but what were some of the operational highlights that you can share with us?
Yeah, so I guess at the core of all of that is the completion of our HBP or our held by production, campaign, which is really, a monumental achievement for us, bringing three very large, quite complex horizontal wells online, getting them successfully drilled, completed, and flowing to sales, is a monumental achievement for the team. Obviously we're very proud of all of that work, and the production that's coming from those three wells is what's underpinning those numbers that we just talked about. But more importantly, than all of that is, what does it mean for the future? What does that do for our shareholders moving forward? And I guess it's the very large inventory, the 20 odd, proved undeveloped locations that we now get to monetize. So those first 3 wells, which take those 3 DSUs from being leasehold to being held by production. In other words, we've transitioned now to a mineral ownership position. And so we can now go and look to the best way to monetize that large inventory of proved undeveloped locations and the reserves that sit in that inventory of wells. So that's where the future is, and it's really now the next phase of growth is all about how do we best unlock that value. And again, without harping on these 3 pillars, it comes back to that 3 pillars approach. So, is it through, the land and leasing side of the business, which would, the A&D, the sort of M&A sort of part of the business, or is it through continued development drilling, or is it through a combination of both of those things? So all of that is driving our strategy for the next phase, which we're busily executing now and into 2023.
Excellent. We had some investors ask as well, or comment that it was a smart move to restructure the loan note, leveraging your deep in the money options to fast track the Flames well.
Yes.
Some of them were asking to see if we could get any flowback data from the Flames well, and how's that tracking, and if there's any data going to be released on that.
Yeah, so I guess a couple of comments there. One is, look, we're really proud of that quite clever approach to raising that capital at a very important time for the business. One of the interesting parts of the Brookside story is that, given our size and given, the fact that we're located in the core of what is now, the most active and highly sought after play in Oklahoma, it means that we are competing with a lot of, very large, well-funded organisations that are pursuing their own development plans. And so that means we operate in what we would call the spot market for services. So we're not committing to to long multi-well programs. We're really opportunistically taking advantage of slots that come, when rigs come available, and we're able to take advantage of that. So there's some challenges in that, but there's also an opportunity in that, right? The challenge is obviously we need to be nimble enough to be able to adjust our strategy and our timelines to fit in with those rig slots when they become available. And we've done a good job of doing that up to this point. And we're going to continue to be able to effectively do that moving forward. The opportunity, of course, means that, is that we're not locked into, some drilling campaign where we've committed to a 1 or a 2 year continuous drilling program, regardless of what the economic outcome might be for our shareholders. So, there's some challenges with that, but there's also that opportunity that enables us to stay nimble. So, and again, that's really important for our shareholders, because we don't want to be in a situation where we're locked into into some sort of a drilling campaign that may not be the best way for us to monetize this fantastic asset that we've managed to get our toe on. Now, in terms of the Flames well itself, it's going particularly well. We're very pleased with the numbers so far, and look, I think we're only we'd expect to get some news out on that quite shortly, so shareholders have something to look forward to here in the near term.
Excellent. No, thanks for that, David. I'm sure we'll have something to look forward to.
Yep.
We were talking about Flames before, but there was a question about Jewel and its production rate.
Yes.
There was a comment that the production rate has declined about 50% over the last 6 months, which is common for newly producing oil and gas wells, right? Could you help explain and maybe educate some of us who are maybe less familiar with the oil and gas industry?
Yeah, sure. Look, natural decline in oil and gas reservoirs is just a function of the physics. Once you start to draw down on the reservoir, you're changing the pressure environment there in the wellbore. And you tend to get flush production at the beginning of the well's life, because that pressure differential is at the opportunity to make a difference in terms of that pressure differential is at its peak. And then over time, the well shifts from that, flush production, where you're getting a lot of hydrocarbons coming out of the naturally occurring fractures, and you move more into kind of what we would call the matrix production, where the reservoir is just now delivering up what it would naturally do over time out of the pore spaces in the reservoir. So that's a natural phenomenon. It occurs in all oil and gas reservoirs, and so the trick is to be able to model that before you drill the well, to get some sense of what that decline rate is going to look like, and then model out what the production is going to look like. And then all of that, of course, then drives that all-important data point that we rely on so heavily, which is the time to pay out. And, we've seen, in our dual well, paid out in, in a very, very short space of time. The Ranges well is set to do the same. And, we have high hopes for the Flames well as well. So these wells are paying out very quickly, and so all of that is is key to the success, right? So you model up what that decline looks like, and see how much production you think you're going to be able to get back in those early months. And if you're in a situation where you're able to recover all of your drilling and completion capital that you've invested in those early months, then that puts you in a very strong position to go forward and invest that capital in future development. But it also gives people looking at the asset really a very high degree of confidence about the quality of the reservoir and what the value of those proved undeveloped locations might look like. So that's all very important. We modelled it up ahead of time, and the wells are performing exactly as we expected them to, which is obviously super pleasing. So no surprises in the decline rates. They're exactly as we had predicted, and we're very pleased with the results.
Excellent. Yeah, no, I think that accuracy of those forecasts and models really speaks to the experience of your technical team. But at the same time, highlights the need for oil and gas exploration in the world that we live in. And, unfortunately, there's really been that under investment, not by Brookside, but, by the industry by and large, in oil and gas exploration, which is why we've now come to a time where supply is so tight, right? Yeah. Now, speaking about exploration, Brookside, you've got 2 more wells planned to be drilled and commissioned by the end of 2022. So that's pretty exciting stuff. Can you tell us how this has been progressing?
Yeah, so look, we're making really good progress on that sort of next phase of development that we talked about. And again, sort of, I guess, drawing everybody back to those 3 pillars again. Every decision that we make around the next steps of development is driven by what's going to be in the best economic interest of shareholders. So, how are we going to get the best outcome from this exciting asset that we've now got our toe on? So, yes, we are progressing with the next phase of development, and again, news out on that shortly in terms of what's next on the drilling front, and potentially what's going on in the bigger picture in terms of the size and scale of the asset and what opportunities we see there.
Excellent. Yeah, that really leads us into my next question is, how are the other 2 fronts or how are the other 2 the other 2 pillars going at the moment? Namely the land and leasing and acquisition side of things.
It's hectic on the ground. I guess. Again, making sure that people watching this understand that we don't need to pursue one of those pillars to the exclusion of the others. We can run them all in parallel. So at all times we've got our eye on the horizon, looking for new opportunities. We've got plenty to do around the Swish area, where we can we're looking to actively try and increase our footprint in what is in a highly sought after area, particularly, I guess, strengthening up our position so in a way that enables us to grow that footprint and make us more attractive to people who might be looking to be active on the M&A side of things. And then beyond that, we've got, the work that we've been doing on our Bradbury opportunity, which is also coming along quite nicely. So, all three pillars active all the time, and the team's busy. And ultimately, as long as we stay true to those values around, making sure that our investment decisions are driven by the numbers, and not by, the need to provide, necessarily provide rapid fire growth for growth's sake. It's got to be about the numbers, right? So yeah, very busy and exciting times.
Excellent. And just looking into the future now, with oil and gas prices slipping slightly or showing some softness, what can investors look forward to, in the execution of your three-pillar strategy or with Brookside in the next 6 to 9 months?
Yeah, so look, more of the same really is, we're really looking forward to being able to capitalise on the fantastic quality of this asset that we now have, within our grasp. So, moving from leasehold to being mineral ownership and that production base, and then how do we unlock the value in those proved undeveloped locations? In terms of the outlook for pricing, we're very bullish on where we see prices, into 2023 and beyond. We think that, structurally, we've seen this, you and I've talked about it before, Tim, but this decades of underinvestment, into what is a depleting asset. We just talked about, the fundamentals of the physics of the reservoir. Well, those same fundamentals apply across the entire sector. So everybody that's currently producing needs to be drilling, exploring and drilling to replace the reserves that they produced yesterday and the day before. So this is the treadmill that the industry is on. And with population growth continuing unabated, and people's desire to use more and more energy and consume more in everyday life, we're just starting to see that imbalance really starting to come through, and it's coming through in Europe and in the US, in a form of that gap between supply and demand, and we think that underpins prices, strongly into the next few years.
Agreed. Yeah, no, thanks for that, David. I really appreciate it. That takes us to the ends of our questions today. Thanks everyone for joining us in this Q&A with David Prentice, MD of Brookside Energy. Really appreciate your time. And if you have any more questions, feel free to reach out to us at Spark Plus or reach out to David directly. Thank you, everyone.
Thanks very much, Tim.